Welcome to the horizon. Let us begin with a moment of intellectual honesty. If you have tuned into the financial news cycle over the last 6 months, you have likely been swept up in a specific kind of euphoria. It is a noise generated by a handful of companies, the titans of Silicon Valley, whose earnings calls sound less like corporate updates and more like victory laps for the age of artificial intelligence. We see Nvidia's astronomical growth, we hear Microsoft's projections, and we are told that a new era has arrived. But as we cross the threshold of middle age, we learn that the loudest room in the house is rarely where the real work is being done. While the tech sector celebrates record-breaking quarters, a profound and perhaps dangerous silence is settled over the rest of the market. This is the great divergence. On one side, we have the AI haves, the architects of the silicon. On the other, we have the AI have-nots, the traditional banking, manufacturing, and insurance sectors that form the bedrock of your retirement portfolio. The gap between these two worlds is no longer just a matter of different growth rates. It is a fundamental misalignment of operational reality. If you are over 40, your wealth likely isn't just in high-octane tech stocks. It is anchored in the boring companies that keep the world moving. Today, we investigate why those anchors may be drifting, and why the celebrate-everything atmosphere of the Nasdaq is masking a systemic risk in the broader S&P 500. To understand the depth of this blind spot, we must look at the data, specifically a recent analysis from Bloomberg. The findings are sobering. In recent earnings seasons, the term artificial intelligence has become a mandatory buzzword for CEOs across every sector. From consumer staples to heavy industry, executives are peppered with questions about their AI strategy, and they are quick to offer reassuring, if vague, platitudes. However, Bloomberg's data reveals a startling mention gap. While the mention of AI in earnings calls is skyrocketing, up triple digits in some sectors, the actual capital expenditure, or CapEx, dedicated to AI infrastructure in the broader S&P 500 is remaining remarkably stagnant. We are witnessing a performance of innovation rather than the practice of it. For the mature investor, this should be a red flag. It suggests that while the tech giants are spending billions to build the tools, the companies that are supposed to use those tools to find efficiencies, your banks, your logistics providers, your healthcare networks, are largely standing on the sidelines. They are talking the talk to please the analysts, but they are not yet walking the walk. This lack of investment suggests a fundamental misunderstanding of the stakes. In an era where AI is expected to redefine margins and labor productivity, a company that refuses to put its capital where its mouth is a company that is effectively managing its own decline. We have to ask, if the hot topic isn't translating into balance sheet action, is it truly an evolution, or just a marketing strategy designed to keep share prices afloat in a volatile market? Long-term portfolio stability has always rested on 3 foundational pillars: adaptability, operational resilience, and capital discipline. Historically, traditional finance has managed technological shifts with a certain measured grace. When the internet arrived in the 90s, or when mobile banking transformed the 2010s, there was a lag, yes, but there was a clear path toward integration. But the AI shift is different, and the pillars are shaking. The pace of this current technological leap is moving at a velocity that traditional corporate hierarchies are not designed to handle. Usually, a bank or an insurance firm has 5 to 10 years to integrate a new core technology. With generative AI, that window has shrunk to 18 months. The risk we are identifying today is not just that these companies are slow. It is that their very infrastructure, the legacy code, the siloed data, the 20th century management styles, is fundamentally incompatible with the speed of AI. For an investor over 40, your focus is on wealth preservation. You rely on the boring part of your portfolio to provide the ballast against market storms. But if those companies fail to adapt their core infrastructure, they lose their operational resilience. They become vulnerable to leaner, AI-native competitors who can operate at a fraction of the cost. This is why we must look beyond the quarterly earnings. We must analyze whether a company is merely surviving the current trend or if it is rebuilding its foundation to thrive in the next decade. If the pillars of your portfolio are built on the sand of legacy systems, then the stability you think you have is an illusion. There is a term circulating in the more analytical corners of the financial world, the S&P 493. It is a necessary deconstruction of the broader market. When you look at the S&P 500 index as a whole, it appears healthy, buoyed by the historic runs of the Magnificent Seven. But if you strip away those 7 tech giants, the picture changes dramatically. The remaining 493 companies, the ones that likely make up the bulk of your mutual funds and diversified holdings, are underperforming. This is the mirage of broad gains. Many investors believe they are participating in the AI rally because their index funds are up. In reality, you are likely heavily exposed to old-world inefficiencies that are being masked by the success of a few silicon pioneers. For the mature investor, this concentration of wealth and innovation is a systemic risk. It means the core of your retirement plan is tied to companies that are currently lagging in the most important technological race of our lifetime. If the tech bubble cools or if the AI haves reached a saturation point, the AI have-nots in the S&P 493 will be left exposed, with no internal AI efficiencies to protect their margins. We are not here to chase the next 10x tech stock. We are here to ensure that the bedrock of your wealth is not crumbling from within. We must acknowledge that a diversified portfolio in 2024 is not the same as a diversified portfolio in 2014. If 90% of your holdings are ignoring the most transformative tool of the century, you aren't diversified. You are simply waiting for the inevitable drag of obsolescence to catch up with your returns. We must address the weight of history. In our previous discussion, we noted the stark contrast between the tech giants and the rest of the S&P 500. To understand why this gap exists, we have to look at operational inertia. For the mature investor, the word legacy usually implies a proud heritage. But in the context of infrastructure, it is often a polite term for a structural anchor. Many of the financial institutions that form the bedrock of your portfolio, the banks founded in the late 19th century or the insurance giants of the post-war era, are currently battling what I call digital sediment. They aren't just missing out on AI because they are slow. They are physically and architecturally hindered. Bloomberg's analysis suggests that while AI is the centerpiece of Silicon Valley earnings, it remains a ghost in the machine for the broader market. Why? Because you cannot simply plug a sophisticated large language model into a core banking system running on COBOL, a programming language that predates the moon landing. These 100-year-old institutions are struggling with fragmented data silos. Their customer data lives in one basement, their risk assessment in another, and their transaction history in a third. AI requires a unified, high-speed data architecture to be effective. For these boring blue-chip companies, the path to AI integration isn't a software update. It is a multi-billion-dollar, decade-long organ transplant. There is also a cultural resistance. Middle management, the very layer responsible for implementation, often views AI as a threat to their expertise rather than an extension of it. This inertia is not just a technical hurdle. It is a fundamental risk to the future earnings potential of the S&P 493. This brings us to a concept that is rarely discussed in the hype cycles of financial media: the hidden systemic risk. When we look at the boring sectors, logistics, insurance, heavy manufacturing, we are looking at the great drag on your long-term returns. If a logistics company in your portfolio continues to rely on manual route planning, while a competitor utilizes AI-driven predictive analytics to shave 15% off fuel costs and 20% off delivery times, your holding isn't just stable. It is becoming obsolete in real time. The risk isn't that these companies will disappear tomorrow. It's that their margins will slowly evaporate until they can no longer support the dividends you've come to rely on. Consider the insurance sector. The entire industry is built on the assessment of risk. If a firm fails to integrate AI into its actuarial models, it will eventually misprice its policies. It will attract the high-risk clients that AI-driven competitors have already identified and filtered out. This adverse selection is the systemic rot. As Bloomberg pointed out, the silence regarding AI in these broader sectors is deafening. For the investor over 40, this is the blind spot. We have been conditioned to see stability in the lack of change, but in a world where the cost of intelligence is dropping towards zero, a lack of change is actually a signal of escalating risk. If the core of your retirement is built on companies that are ignoring the most transformative efficiency tool of our century, you aren't diversified. You are simply exposed to the friction of the old world. So, how do we navigate this as stewards of our own wealth? We move beyond AI exposure and toward AI resilience. The Horizon strategy isn't about chasing the next NVIDIA. It's about auditing your existing holdings for fundamental structural shifts. You must look past the earnings call scripts. When a CEO mentions AI, don't take it at face value. Look at their capital expenditure. Are they investing in data infrastructure? Are they hiring data scientists at the expense of redundant middle management? An AI-resilient company is one that is actively dismantling its legacy silos to make room for a new operational core. We are looking for companies that use AI to solve unsexy problems. A bank that uses AI to detect fraud with 99% accuracy is more resilient than one that just launches a chatbot. A manufacturing firm that uses computer vision to eliminate defects on the assembly line has a structural advantage that will manifest in its balance sheet for decades. This is an intellectual audit. It requires us to look at our portfolios not as a collection of tickers, but as a collection of operating systems. Is your operating system up to the task of the 2030s, or is it still running on the assumptions of the 1990s? Resilience is found in the companies that treat technology as a foundational pillar, not a marketing buzzword. Intellectual honesty is the only hedge against a changing world. It is easy to be swept up in the euphoria of record tech earnings, and it is equally easy to be lulled into a false sense of security by the stability of the traditional market. But the data from Bloomberg serves as a necessary wake-up call. The gap between the tech leaders and the rest of the market is not just a performance gap, it is a preparation gap. For the mature investor, the goal is not to catch every wave, but to ensure that the ship we have built is seaworthy for the storms ahead. Sustainability is found in operational excellence, not trend following. As we look toward the next decade, the greatest risk to your wealth isn't volatility. It is the quiet, steady drag of obsolescence in the companies you thought were safe. Watch the horizon, pay attention to the infrastructure, and remember, in an era of rapid change, the most dangerous place to be is standing still. This is the horizon. Until next time.